We're going to finish up chapter 10. We got most of the way through it, but there are a couple of things that we haven't talked about yet. So up to page 320 is look. And then we'll try to do most of chapter 11 also today. And that'll clear the way for us to start talking about business income on Wednesday or Friday. Yeah, chapter 10 today, 11 Wednesday, business income on Friday. Okay, so to summarize what we've learned so far in chapter 10, there are two main education credits. There's the American Opportunity Credit, the Lifetime Learning Credit. The American Opportunity Credit is a credit of up to $2,500. That's primarily for undergraduate students who are at least half-time. And that's normally going to be claimed by whoever claims that person as a dependent. So it's up to $2,500. 60% of it is non-refundable, 40% of it is refundable. So that's up to 1,000 refundable credit. And that's $2,500 per student, based on up to $4,000 in education expenses. The other credit is the Lifetime Learning Credit. That's a lot less generous, but it's more, there's less restrictions on who can claim it. It's for any students, regardless of the number of classes or whether they're in a degree program or whether they already have a degree or whether they're a drug-related felon. So that is 20% of your qualified education expenses, up to a maximum of $10,000 in expenses or $2,000 credit. And that is a non-refundable credit. So if people are lower income, they might not be able to get any benefit at all for that. Okay, so do we have any questions before we continue on? Okay, if not, we're going to talk first about tuition and fees deduction. The only thing we have to say about that is there is no tuition and fees deduction. There used to be the opportunity or the ability to deduct your tuition and fees as an adjustment instead of taking a credit for them, but that's no longer available. And the next education benefit is really afterwards. Once you've already been through college, you can deduct your student loan interest. And this is a deduction of up to $2,500 for each student. Or no, I'm sorry, $2,500 per return. And once again, you cannot take this credit if your filing status is married filing separately. You can't take this credit or it's not a credit, it's a deduction. You can't take this deduction if someone can claim you as a dependent. And you can't take this deduction if you're not legally obligated to repay the loan. So if your son or daughter, for example, got their own student loan and you're not listed as responsible, so you didn't co-sign the loan, then you can't deduct any student loan interest that you pay on their behalf. Only the person who's responsible for the loan, or more than one person, can take any deduction for student loan interest. Okay. For student loan interest, you may receive a 1098-E that tells you how much student loan interest you paid during the tax year. And this is very similar to the other forms we've seen. So on the left, we have the recipient's or the lender's information, the payer or the borrower's information, and just one box here for the amount of interest, and one checkbox down here, which is mostly irrelevant. It's whether or not capitalized interest is included in the balance of the loan, which is gonna be treated the same way either way.
One question,
Mhm.
it mentions you cannot be claimed as a dependent.
Mhm.
So you would think there'd be plenty of students that would be taking out student loans
Mhm.
that would still be claimed as dependents by their parents, but yet they're still taking out student loans, and so they're they all
Right, but you
disqualified?
don't, they can't take the deduction. Normally, a lot of student loans are co-signed by their parents, but if not, if the student is taking out their own loans, those loans don't usually start being repaid until after you graduate. So there's not gonna be any interest to deduct.
So they wouldn't be getting these likely until after they graduate?
Right, you don't start getting these until after you graduate.
Ah, okay.
So you might borrow $10,000 a year for 4 years straight while you're in college, and then you have $40,000 in balance that you have to pay, and then you start paying it back. And so normally you won't get have any student loan interest paid until after you're done with school, and you won't be a dependent anymore.
Does the interest accrue while you're in school?
It depends on the exact terms of the loan. I believe, when I took out the Alaska student loan, the interest was paid for by the government. So it didn't actually add to your balance. So, and I think Stafford loans work the same way. The government will pay the interest while you're in your deferral period, while you're still in school. But once you're out on your own, you're no longer in the deferral period, you've graduated, then the interest gets charged to the student.
Okay.
But for this year, there's no deduction for student loan fees.
Tuition and fees, there's no deduction for tuition and fees. You can only take one of the credits.
So if someone graduates in the spring, like, which is typical, right? Would they start getting this one that same year after that year of graduation? Or would
If they
fall-
made any payments on their student loan, yes, then some of it will be interest.
Or do you know if like the deferral oftentimes goes through the end of the year or anything like that, and then they start receiving one the following year?
I think the deferral is 1 year after you graduate, so you still have one more year. So if you graduate in the spring of 2024, you don't make your first payment until 2025, but don't quote me on that, I could be wrong.
Generally, it's the following year afterwards that you might start getting one of these.
Yeah.
Okay, gotcha. Do you know if student loan interest is still like heavily subsidized, or is it like close to market rates for everything now?
It's pretty subsidized because it's, for two reasons. First, it's guaranteed by the government in general. So that even if you default, the original lender will be made whole by, so instead of owing the lender, you end up owing the Department of Education. So the Department of Education will make those payments for you. But you'll still owe, you still owe the balance. So there's no risk to the lender. So because there's no risk, it's a really low interest rate. So like if you're a borrower and you buy a car and you have no credit history, you'll probably get like a 15 or 20% interest rate. But it's not going to be like that with the student loan because there's no risk to the lender. They're going to get paid one way or the other.
So like right now, mortgages being 7, 8, 9% or whatever, right? Would you expect student loan to be in that range, or even lower in that like 3, 4%?
I would expect student loans to be around a good mortgage rate, about the same. So they're a little bit more risky than like treasury bills or government or U.S. bonds.
So they're definitely not way down low where it was just a few years ago.
Yeah.
Okay.
But no, I don't know what the interest rates right now for student loans are.
Gotcha.
But I remember when I took mine out, it was about 8%, which is about the same price as a mortgage at the time. Okay, so this amount is going to be amount that you can deduct, whatever's in box 1. You might get multiple 1098s because you have multiple students, or maybe you have multiple loans for one student. And those combined, you can still only deduct up to $2,500 in student loan interest. you might not get a 1098E though, because a qualified student loan is defined as any loan that you took out solely to pay qualified education expenses, 100% for qualified education expenses. So that means if you took out a home equity loan or a personal line of credit or something like that, and you use that only to pay your qualified educational expenses, then that counts as a student loan. So if you refinance your home and take out $80,000 to pay your kids' tuition, then that counts as a student loan. But if you took out $80,000, it has to be 100%. So if you took out $80,000 to pay $60,000 toward your kids' college and $20,000 toward just paying off your own credit card debt, then it's no longer a student loan and none of the interest is deductible.
In a scenario like that, does the date of removing those funds from your equity, is that the primary thing? Or if, say, 1 or 2 or 3 months later, you pulled out money again, and that time it was for something else?
Well, you have to be able to trace the proceeds to paying your education expenses.
So even if you had multiple withdrawals, that particular withdrawal has to be.
Well, the loan, so if you have a home equity line of credit, you can make draws over different periods, but the whole loan has to be applied toward education expenses.
Okay.
So if you take out $20,000 one day to buy a car, and you take out $40,000 another day to pay your kids' tuition, that's not a student loan.
So even if it's different times, you just don't want any contamination.
Right. Yeah,
Okay.
it has to be solely 100% for education expenses.
If they find out you bought a pack of gum, not a student loan.
Well, thank you. I think it wouldn't be that simple because a dollar's a dollar, but
Yeah, I mean, if you can trace those funds to the cost of college, then you could treat it as a student loan. Since money is fungible, you could probably do that.
even without the 1098, correct?
Yeah, but you would have to you'd have to come up with your own documentation and proof that it qualifies as a student loan if you don't have the 1098E.
So if you pay your tuition and then, or say I pay my kid's tuition and then I pay for her apartment with the loan, would that still be considered a student loan because it all goes towards her education?
Yes, so the list of qualified education expenses are different for purposes of a student loan than they are for purposes of American Opportunity Credit and Lifetime Learning Credit. Let me see if those are on the next slide or not. Yeah. So your list of qualified education expenses include your tuition and fees and related expenses as usual, but it also includes, for purposes of student loan deduction, room and board and other necessary expenses such as transportation. So yes, if you use that money to pay for your kid's apartment, or pay their bus fare or taxi fare, or to buy them a car that they use to get back and forth to school, that counts as transportation expenses. Those all count for student loan interest deduction.
Are you able to almost count certain, like tuition twice if you're paying with a loan, yet you also pay funds that, had whatever document we were talking about before that had is it 1098T?
1098T for tuition and 1098E for student loan interest. Yes, that you can use the same expenses for both American Opportunity Credit or Lifetime Learning Credit and for student loan interest, because you're not really taking a double benefit. You're getting a benefit for the money you spend for college, and you get an education credit for that, but you get a deduction for the interest you pay on top of that. So it's the interest on top of what you paid for school. So it's not really a double benefit.
But then they'd have to be itemizing at that point to even take advantage of it.
No, No, this is actually, the student loan interest deduction is an adjustment rather than an itemized deduction. So this is taken on Schedule 1 on, somewhere on page 2 of Schedule 1. Because it's an adjustment, it also affects your adjusted gross income, so it may improve your chances of qualifying for some other tax benefits besides just the student loan interest deduction, such as earned income credit and things like that. Okay. So, whose student loans can you deduct? You can deduct student loan interest for yourself or any person who could have been claimed, well, anybody who was claimed as a dependent the year the loan was taken out. So if you co-sign your kid's loan and you're making the payments on it instead of them, and even though they're no longer your dependent, they're off on their own and making their own money, they're too old to be your dependent, you can still deduct your student loan interest for someone who was your dependent at the time they were in school. And you can also deduct, treat them as a dependent for the purposes of that rule if they could have been your dependent except for the fact that they filed a joint return, or they would have been your dependent except for the fact that their gross income is too high. So you can claim student loan interest for people who are mostly your dependents, but not technically all the way your dependents. And you can also take student loan interest deduction for loans that you took out while you were a dependent, but you're no longer someone's dependent, now you're paying your own student loan interest. You can't count student loan interest as making payments from money you borrowed from relatives. So if your grandparents say, okay, we're going to pay for your college, but you got to pay us back, and we're going to charge some interest, well, that's not going to work. Some lenders will allow you, not all, but some, like some of these, you may occasionally see junk mail from some like debt consolidation companies or something like that. Some of those lenders will allow you to sign an affidavit saying that you're using this money only for education expenses, or it still counts as an education loan if you use the proceeds to pay off a prior qualified student loan. So if you sign that affidavit, assuming the lender allows that, then the lender will voluntarily produce a 1098-E for you. So let's say maybe you owe $60,000 in student loans at like a 9% interest rate. You might be able to find a way to refinance that or borrow that same amount of money at a lower interest rate and pay off your student loan, but this new loan is considered its own new student loan and still qualifies for the student loan interest deduction. Okay, as usual, you have to reduce your qualified expenses by any tax-free assistance you get, including things like scholarships and grants or veterans educational assistance.
How do you reduce your interest and stuff like that?
Well, you reduce your qualified expenses.
Okay.
You're not reducing your interest, you're reducing the qualified expenses, which means that you have to be sure not to borrow more than your total qualified expenses, or else you ruin it for being a qualified student loan.
But that includes all your room and board, though. You're
Yeah.
able to count that.
Mhm.
But I guess I'm just a little confused how scholarships, because it seems like scholarships get used first, right? So why would you have to subtract those out after the fact anyway, if that doesn't affect how much you're borrowing?
It does, it might affect how much you're borrowing. So let's say your tuition for a year is 20,000,
Mm-hmm.
and then your room and board for the whole year is another 20,000.
Okay.
And then reasonable transportation expenses might be another 10,000. So that's 50,000 in total qualified education expenses. And you might have a scholarship that covers room and board and tuition, so you might get a $40,000 scholarship. And then if you go off and borrow $20,000, well, you've exceeded, because you have your 50,000 in qualified education expenses, that's tuition, room and board, and transportation, and you reduce it by the 40,000 in non-taxable scholarships, and then you only have 10,000. So if you borrow more than 10,000, it ceases to be a qualified student loan.
So if you're borrowing more than your total actual expenses.
Yeah.
If you're borrowing surplus, you're borrowing extra to cover your spring break vacation or something like that.
Right.
Alright.
So basically what this means is by reducing those expenses, it's saying if you borrow more than what you need, then it's no longer a student loan because you're no longer borrowing for qualified education expenses. Okay, let's see. So student loan interest is a deduction for interest you paid on a loan that you used to attend a qualified eligible educational institution, and that is defined as basically the same thing as for the education credits, which is any post-secondary institution eligible to participate in federal student aid. And to come back to your question from last week about foreign studies, there are some foreign universities that are eligible to participate in U.S. federal student aid. So those ones you could attend and still get, your education credits and your student loan interest deduction.
Interesting.
Okay, and then an eligible student is anybody who is in a degree program. Okay. And then there's also an income phase out. So I passed out the cover sheet, the front cover of the Quick Finder a while ago. And our phase out for the student loan interest deduction is based on, it's going to be called modified adjusted gross income, because we don't want to make any circular calculations. So this is, because it's an adjustment, it adjusts your adjusted gross income. So modified adjusted gross income means we just ignore student loan interest for purposes of calculating this number. If your income is is less than 70,000 or double that for joint returns, then you get the full benefit, so the maximum 2,500 student loan interest. If your income is over 85,000 or double that for joint returns, you get no student loan interest deduction. And if you're between those, so somewhere between 70 and 85,000 or double that for joint returns, you get partial student loan interest deduction.
So if you're a head of household, you get no more benefit than if you were single in this case, right?
Right. Mm-hmm. Okay, and next, this is going to be, well, has been and will be important last year and the next couple of years. If your student loan is canceled, well, normally any loan that is canceled, we talked about cancellation of debt way back in chapter 4. Normally, canceled debt is considered taxable income. But if it's a qualified student loan, which means a loan for post-secondary educational expenses, then you can exclude that cancellation of debt from income. So this first paragraph is just reminding us of the general rule, but it's telling us that for student loans, there's an exception to that. Okay, and then there's some more caveats on what loans count as student loans for this purpose. And some more of that. Let me look at this worksheet real quick. Okay, and then I think this is the final part of this chapter is Coverdell savings programs and qualified tuition programs. Coverdell, I haven't seen that much lately. I think it's obsolete. Mostly we have qualified tuition programs and 529 plans. The basic idea for both of these, and I'm not sure exactly what the difference is, but the basic idea for a Coverdell and a 529 plan, 529 is the section, the code section that in the law where this is defined. The basic idea is you can save money for education expenses, and that can grow tax-free, and then you can spend that money on your education and never pay tax on the earnings. So it's fairly similar in concept to a Roth IRA. You put money in, you don't get a deduction for putting money into your 529 plan. But as long as you use it appropriately and correctly, you don't pay taxes on any of the growth.
Are you limited on how much your contribution can be?
There is a contribution limit, yes.
I'm just thinking, it may not be very effective where someone starts when their student's already like a high schooler, right?
Right.
Because they may not be able to put much in to begin with.
So Coverdell Education Savings Account, I haven't seen these much, but one of them, the limit is $2,000 per year per student, so that's not very much actually.
Not unless you start when they're a baby, pretty much.
Right. I'll probably skip most of this because I don't really see Coverdell as much. And I'll skip ahead to the qualified tuition.
So the Coverdell and the 529, they both are somewhat like a rock.
Yeah. Okay, qualified tuition programs are, there's two types. One is one that's run by a state or university, and that is where you prepay tuition at today's rates for future education. So you can pay for your college tuition for your newborn at today's tuition rates, and when they turn 18 and are ready to go to college, or they graduate from high school, they're ready to go to college, that tuition's already paid for, and in 18 years from now, tuition may be double or triple what it is today. So you save money that way. That's one type of qualified tuition program. The other type of qualified tuition program is where you put money into a savings account, or it could be a brokerage account, some sort of savings account, and it grows tax-free. So it could grow either with inflation, with the inflation of tuition, or it could grow at market rates, depending on which choice you make. Okay, and then, let's see. And the limitation on how much you can put into a qualified tuition program is flexible. It's whatever would reasonably be required to actually attend school for a full 4-year course. Which is, however, is defined by the plan itself. The plan can say, well, you can put up to a maximum of 120 credits worth of, prepaid tuition.
So I take it every year the cost per credit that you pay would probably increase.
Yeah.
Maybe as you put into it, in your early years, you're going to cost less than your later years.
Yeah. Let's see.
What happens with these kind of plans when suddenly a student decides not to go to school and the parent already has an educational account for them?
Then you'll have to take that money out, and it will be subject to tax at that point. So as you contribute, you don't get a deduction, the money grows tax-free, and if you use it for education expenses, then you don't pay tax on any of the earnings. If you take money out for any reason other than qualified education expenses, then part of it will be taxable. And unlike a Roth where you're considered to take your basis out first, it's more like a non-deductible IRA where it's going to be proportional. So let's say you're going to multiply your distributed earnings by a fraction, which is the ratio of your total contributions and the total value of your account. So, for example, if I put in, let's say, maybe my kid was born 17 years ago, so maybe 2006, and I've been so I've contributed $1,000 a year toward my kid's education. So I put in $1,000 per year. Through 2022 maybe. So that's 17 years. So my total contributions that's 17 separate years. So my total basis is 17,000. And maybe through market growth or the growth in the cost of tuition. So this is my basis, and then maybe my account value at the time. After 17 years, maybe it's worth 26,000. So those are the two numbers that will turn into a fraction. So that means for every dollar I take out, 17 out of 26 is getting my already taxed money back. And the remaining part, so this would be non-taxable, and the remaining part would be the other 9/26.
Would that ratio then keep changing as you do it? Or is
Yeah,
that-
because the account value is going to keep growing. So let's say, something happens and I need to borrow money for my kids, take money out of my kids' saving education account to pay for, home repairs or something. So, and that's the only place I could find that money, and I need to pay it. So let's say I take out, let's say I distribute. Let's say $5,000 for non-educational expenses. If I take out $5,000 for educational expenses, none of it's going to be taxable, because that's the compact for a 529 plan. But if I take out $5,000 for some other reason other than education expenses, then this 5,000 times 9/26 is going to be taxable income, and I don't know where that's going to come out to.
It's like roughly a quarter.
Yeah. 5 divided by 26 times 5,000 is,
You said you did 5 divided by 26, you meant 9 divided by 26?
7. Oh yeah, 9. So I'm going to end up with 1,730 taxable and then 3,170 is non-taxable.
We make it 270.
Yes. And this non-taxable part that I took out of my savings is going to reduce my basis, because I'm getting that back tax-free. So I'll end up, at the end of this transaction, I'll have 13,730 basis left in that account. So you'll only need to make this calculation when you take distributions, when you take taxable distributions from that account. And whenever you take any distributions, whether they're taxable or not, you get a 1099-Q from whoever's running the 529 plan. If you can say that all of that money was used for education expenses, then it's going to be non-taxable. But if you use it for some other purpose, then part of it's going to be taxable.
So if you use, I guess, if you use the difference between non-taxable and the taxable part, can you pull that out and use just that 9/26 worth of your total for education, and then you pull out the rest and it's all non-taxable?
No. No, it's always going to be proportional.
Okay.
So if I spend like 17,000 on my kids' expenses, then these numbers are going to go down in the same proportion.
You said that it counts as if you're using your non-taxable funds first?
No, that would be under Roth. I said it's unlike that.
Oh.
So it's always considered proportional between your basis and your earnings. So this is 9,000 earnings. So if I spend 13,000, then whether it's taxable or not, if I spend 13,000 out of this account, then my basis is going to be cut in half, my earnings are going to be cut in half, my account value is going to be cut in half.
Does your basis continue to reduce?
Every time you take money out, your basis will go down.
But what happens if you have a total basis of 17, and from the beginning you use 5,000 for education expenses first, and so the account value drops to like 21? Is
Yeah.
that-
Then I'll still have 3,270, so this part will be, not only is it non-taxable, but this is a return of basis. So if I do use this 5,000 for education purposes, my basis will still go down by $3,270.
Oh, okay. You just won't be paying tax on that other differences
Right.
except for education, but you're proportionally, you're saying the basis still gets reduced.
Right, so another way to think about this, or to write this that might be more precise, is this 1,730 came from earnings, and it might be taxable or non-taxable depending on how I use that money. And this 3,270 came from basis. So it's going to reduce my basis regardless of how I use this money.
Gotcha. And wait, this is the Coverdell, or this is the 529?
This is the 529. The Coverdell is basically the same. Coverdell is basically the same concept. Okay, and then, so not only, so if I don't use this for education expenses, this 1,730 is going to be counted as income. It's going to be counted as income to whoever gets the money. So if I'm taking money out of my children's 529 plan and using it for something that's not related to that person's education, then it's going to be taxable on my return.
Even if someone else put the funds there to begin with?
Yeah.
So if the grandparents keeps contributing to this, then, and then a parent pulls money out, then the parent would show the income on there.
Yes. Mm-hmm.
Okay.
What if the parent pulls it out to buy the kid a car instead? What if the kid?
Well, it depends on who gets the check, who gets the money. So another possibility is the kid, this might be received by the kid, it might have been sent to the college, but then there's more paid to the college than was actually required to be, and the kid gets a refund check from their financial aid office. If it goes to the child, directly to the child, or directly to the university, which then gets refunded back to the child, then this will be income to the child.
But like you said, the example of buying a car, if someone built up a larger savings account for their kid, and within that they pull money out for a vehicle for them to go to college with, could that potentially
That could,
be tax
well,
free
let's see.
as a transportation expense?
For qualified tuition programs, or qualified education expenses include tuition, fees, books, supplies, equipment, computer and internet service, room and board, if you're at least a half-time attendee, but not transportation.
Transportation works when it comes to interest deduction.
Right.
But it seems like nowhere else.
Yeah, counts for student loans, transportation does not count for anything else. Room and board counts for student loans and counts for qualified education expenses if you're at least a half-time student. But room and board does not count for the education credits. So if this excess money maybe went to pay for, their rent for their apartment near campus, then that would count as a qualified education expense, and that you could exclude that from income.
But since money's fungible or whatever,
Mhm.
one can, generally speaking, just count up how much rent they had and just
Yeah.
work towards that. They don't have to track it in such a way.
Right. And then if you also take this money out for non-education expenses, there's also a 10% penalty, just like an IRA, for non-qualified distributions. Okay, and then when we have a 529 plan and someone also wants to take the American Opportunity Credit or Lifetime Learning Credit, but more often the American Opportunity Credit, we can, just like when we took scholarships and grants, we could allocate income or allocate the scholarships and grants such that we get up to the maximum of $4,000 to max out the American Opportunity Credit. We can do a similar thing with the 529 plan. We can treat some of this as taxable income if we want. Some of these distributions as partially taxable income in order to max out their education benefits. And in that case, if we do that, then that's one of the exceptions to the 10% penalty. So let me see if I can demonstrate how that works by example. Where's my, there's one. Okay, so let's keep the same basis and account values. So we have a basis of 17,000 in our kids' qualified tuition program, and the value of the account is 26,000. And let's say their total tuition and fees and related costs for the year were 10,000. And let's say we took out 10,000 of distributions. So we have a $10,000 distribution. So one thing you could do is you could allocate the entire distribution toward tuition, which means you won't pay tax on any of the distribution. None of it's going to count as income. But if you do that, it's going to be called adjusted qualified education expenses for purposes of the American Opportunity Credit is going to be 0. So this is the scenario where we allocate all distributions to tuition.
You're saying if you use these pre-tax dollars to pay for education, then you don't get an American Opportunity Credit?
Right. So let's say we can do it that way. That doesn't seem all that beneficial. So let's say instead we want our adjusted qualified education expenses. We want to max out the American Opportunity Credit. So we want this to be 4,000. So we can get the full $2,500 education benefit. These numbers are still the same. We still have 10,000 in tuition. That comes from our 1098T. $26,000 here, 17,000 here, and then we want $6,000 of tax-free distributions. And we want, so that will give us our $4,000 adjusted qualified education expenses. But then we'll also have a $4,000 taxable distribution.
And would that count against the student or the parent?
That would count against the student,
Okay, so they might
because it's
have,
going to the benefit of the student.
so they might have a somewhat of a standard deduction to work against that anyway.
Yeah, they might. So we have this $4,000 taxable distribution, and then we would run this through the same formula. 4,000 times 1726 is return of basis, which is going to be $2,615. And that means the remaining amount should be 1,385 earnings.
So if they got no other income and they got a standard deduction of what, like 10,000, 1,050?
1,150, yeah. So, yeah, so let's say on
But if they got more, say they made another 5,000 part-time work, right, then that would, or would it almost be the same net?
right. Well, let's say, well, no, because your standard deduction is only 400 plus your earned income.
Oh, okay. With them, so you get the max
Yeah,
of non-earned income by just the minimum altogether.
right. So let's say we have a student and maybe they work part-time, so W-2 of 5,000. And then we have PFD of 1,300, is it 12 or 16?
12.
And then we have 529 taxable of 1,385. So their total income is going to be something like 7,697. Standard deduction is going to be 5,000 plus their earned income, or 400 plus their earned income. So they're going to have taxable income of 2,297.
Times roughly 10%, so roughly
Yeah.
$229, $230 within $5 probably for that.
Yeah, so it's going to be close to 10% of this, but because this is going to be treated as investment income. So they're actually going to run into an issue with the kiddie tax. Because their total income is more than, their total unearned income is more than 2,300. So they're gonna have about 397 of this is subject to their parents' tax rate. But it's still gonna be mostly a better benefit because this $4,000 in qualified education expenses is going to result in a $2,500 American Opportunity Tax Credit. So they're gonna get an extra $2,500, but they might have to pay an extra $150, $160 in tax on their kid's tax return.
And the American Opportunity Credit, that if they had scholarships that covered the full cost of their tuition and books, right, then they wouldn't be able to use that anyway, right? Even if the education from the 529 was used for all the other room and board, they still wouldn't be able to use the American Opportunity Credit
Well,
if they basically had a full ride
if they had a full ride, you can still
or
allocate
all that stuff.
4,000 of that as a taxable scholarship.
Oh, okay.
Remember we talked about that on Friday. You can allocate your scholarships to be taxable scholarships in order to take advantage of American Opportunity Credit. Another interesting fact about qualified tuition programs is that you can use them for attendance at an elementary or secondary public school or private school. And that's limited to 10,000 per year. So if your private school tuition is 15,000, you can use up to 10,000 of your qualified tuition program to pay those expenses. So elementary and secondary means K through 12.
But by that point, you may not have much in there to begin with if you're only limited to putting 2,000 a year in, right?
There's no limit. The Coverdell had a 2,000 per limit.
A 529 doesn't?
529 has no contribution limit other than whatever is determined by the plan administrator.
So the plan administrator, which might look at like national costs between private and public and take an average of whatever they do,
Yeah.
it might be a pretty high number at that point.
Yeah, but there's no set number in the law that says this is the amount you're allowed to contribute. It's yeah. So the plan administrator has to come up with a reasonable amount necessary for qualified education expenses.
Does it have to be? Does the plan have to be in the name of the student, or can expecting parents start before the kids are even born?
The parent is considered the owner of the account in general, but the student has to be the named beneficiary. So you're going to have a qualified tuition program. So it's going to be Michael Schmall qualified tuition program for the benefit of whatever child is already in existence at that point.
So ultimately, you need to have a social security number for the student, for the child student,
Right.
before you can open up an account for them.
Right. So you can't start a qualified tuition program for children who haven't been born yet. So you can't anticipate. You can't start at as soon as you get a job, you can't start saving for your eventual children's college that you don't know if you're even going to have any kids yet.
Right, and that's what I was thinking, is like, what if they wanted to use this towards their preschool or private school, for K through 12 and all that kind of stuff? Could they have started
Well, you could.
well in advance?
Well, once your kid's born, you can say, well, I don't want my kid in the public school system. I'm going to start saving up for the private school. And you can start saving up as soon as they're born, and depending on the plan, they may admit that. So you could have K through 12. That's 13 years. So you might be able to save up to $130,000 for before college expenses for the regular K through 12 education.
So, it is tax deductible or not?
It's not deductible. There's no deduction when you put it in. It just grows tax-free.
Gotcha.
That's why you have basis. Basis is money in some sort of investment that has already been taxed.
So it's kind of just a hybrid between the Roth and the regular IRA.
Yeah, it's very similar to a non-deductible traditional IRA, which you would have if you put money into an IRA and your income's over a certain limit. Like if your income's too high, you can't contribute to a Roth IRA. You can't deduct traditional IRA contributions, so you could just contribute to your traditional IRA without taking deductions. And it's the same thing. When you take that money out, proportionally, part of it's taxable, part of it's not.
Do you, I don't know if I asked this before, can parents contribute, I think we covered it, into the Roth IRA of the child?
Yes, as long as the child has taxable earnings.
Okay, that's right.
So they have to have earned income. Remember,
So-
you can't contribute more than your earned income into a Roth.
So, even PFD wouldn't count for young
No.
children?
earned income is earned income. That's your limitation. So they have to be working for you to contribute to a Roth IRA.
So parents might nudge their kids to get some kind of jobs in
Mm-hmm.
middle school, high school, whatever, summers, and match that in a way if they wanted to,
Yeah.
into a Roth.
Yeah, if your kid had a part-time summer job and they made $5,000, you could put $5,000 into a Roth IRA for them.
Okay.
Okay, and then another special rule is that you can use up to $10,000 from your 529 plan to pay off student loans. That's a lifetime limit, not a per year limit. But if you do that, there's a no double benefit rule, so you can't also deduct your student loan interest because you're paying it with tax-free distributions from your 529 plan.
So in that same year, you can't kind of take both, or you have to somehow proportion it out?
You would have to proportion it out. So if I paid $10,000 toward my student loans and I also paid $10,000 out of pocket, then half of my student loan interest would be deductible student loan interest.
Okay. So if someone doesn't use up their full plan, and there's by the time they get out of bachelor's, they can just hold on to that account and let it continue growing and continue potentially contributing to it for potential grad school and such.
There are some age limitations. Let's see. Some definitions. There's 1080T. Scholarships and fellowships, so we'll skip. Did I miss it? We had some rules about rollovers. Okay, scholarships and fellowships, that's going to be a separate section in this chapter. So I guess they didn't talk about rollovers in the slides, and they're not talking about it in the book. So this is going to be, I'm surprised that they didn't have this in the book. So
It mentions rollovers, but it mentions more so like changing the beneficiary name and stuff like that.
yeah. Oh, where did we see that?
It's page 330 on the.
Oh, look, there it is. So that was from Coverdell's, but qualified tuition programs can also be rolled over. So, so we have some rollover rules, and let's see. You can transfer benefits from one beneficiary to another, and they have to be related. So, so one of the oops, let's turn on the route in this. Let's see, and so they have to be related, and the relationships are, so, so beneficiary's spouse, beneficiary's children and descendants, siblings, nieces and nephews, aunts and uncles, parents and other ancestors, aunts and uncles, I put that, nieces and nephews, aunts and uncles, first cousins, and in-laws who are as equally related as any of these others. So your father-in-law or mother-in-law, except for in-laws, first cousin in-laws don't count for some reason.
First cousins of in-laws?
Yeah, well, spouses of first cousins or first cousins of your spouse don't count. But if you're married filing joint, then you're considered one unit. So it'd be your first cousin's spouse can't be a. This is the relationship to the original beneficiary. So normally we'll just see people transferring from like the older child to the younger child. But if you're, if you have 3 kids and you do this, keep doing this rollover to the younger child, and you run out of children, and you still have money left, you could put it into the oldest siblings' children. Maybe they have children by then, and that would be the original beneficiary's niece or nephew. So I think that's one reason why they relax it a little bit and make it first cousins. So once your youngest child graduates from college, if you still have money left in a 529 plan and you have any grandchildren at all, you could transfer it to one of your grandchildren and keep going.
Oh, okay.
Let's see.
Or they can just pull the money out at that point, right, and just count it as taxable income.
Yes.
At that point, once they're out of kids and they don't have anywhere to roll it over, is there still a penalty?
Yes. Yeah, anytime you use these for non-qualified education expenses, there's going to be a 10% penalty.
But in this case, the room and board doesn't count, right, qualify for these?
Room and board does count as a qualified education expense as long as you're at least a half-time student. And I should make a copy of this chart that I've been relying on.
337, it mentions qualified education expenses do not include room and board on that one.
That's where we've moved ahead to scholarships and fellowships. Okay, so here's a copy of the chart that I've been relying on. It's not in the book. Let's briefly talk about scholarships and fellowships. In general, scholarships and fellowships are tax-free as long as they're used for qualified education expenses, which is the same. In this case is tuition and fees and course-related expenses, books, supplies, etc. And they do not include room and board and things like that. So it's very similar, almost identical to the expenses, qualified expenses for the American Opportunity Credit. And you can take and anything that's not, any scholarships or fellowships that are not used for qualified education expenses are taxable income. Okay, and you report that, there's a special line on line one of those sublines, like 1F or something like that, where you report the taxable part of scholarships and fellowships.
See, I always thought fellowships were just like a stipend for work you were doing as like a grad student or something like that.
Maybe, maybe not. Let's see, if you are, one other rule that's not really mentioned in here is if you're awarded a scholarship or fellowship in exchange for work that you're doing, it's actually not going to be reported as a scholarship or grant at all. It's going to be reported as W-2 taxable wages. Okay, and then here's some other tax or educational assistance. Veterans benefits are always tax-free. So if you're, like GI Bill, or you're disabled vet going to college for free, it's always tax-free. And in this case, you can't allocate part of it as taxable income. It's just by definition tax-free. So if you're getting a full ride as a veteran's benefit, you can't normally also take the American Opportunity Credit. And then one more thing that we haven't mentioned is you can take money out of your IRA without the 10% additional tax to pay for education expenses of, let's see, yourself and certain people who are related to you, even if they're not your dependents.
So is that even like a better deal than the 529 that doesn't give you a taxable benefit to the contribution?
Yeah, you can use it basically like a 529. So you can use that for, let's see, it looks like yourself, your spouse, your children, and your grandchildren, but not your dependents in general. So if you're retired and you have $1 million in your IRA and you don't think you're going to use it all, you can just pay for your kids' college and take that out without taking the 10% penalty. Well, you wouldn't be in the 10% penalty if you're over 59 and a half anyway, but maybe you're in your 40s and your kids are in school or getting ready to go to college. You can say, well, I've saved up a bunch for retirement, but I haven't saved any for college. You can use your retirement savings for college. It'll be taxable in the normal way, but it won't be subject to the 10% extra tax.
Wait, it will be taxable?
Yeah, it'll be taxable in the normal way. If you take money out of your 401k or your IRA, that's normally taxable income.
Okay, it's not excluded from being taxable?
No, it's not excluded from tax, but it is excluded from the 10% penalty.
but then you'd still be able to use other credits and everything like that, probably along with it, right?
Yes. Because you're paying, so you, like the American Opportunity Credit, you're paying for that with taxed money, so you're not paying for it with tax-free money, you're paying with taxed money, so you can get a credit based on that. Education savings bond is fairly uncommon, so we won't talk too much about that. All right, so let's see if we covered everything. So the classwork will begin on page 341. Okay, so first, the lifetime learning credit is only for a dependent who's in the first 2 academic years of post-secondary education. That is false. Lifetime learning credit has no limit regarding the number of years of education. Okay. Number 2, true or false, Dimitri?
The American Opportunity Tax Credit can be taken for any 4 years of education at an eligible educational institution. False, because it's only for undergraduate.
Correct. Yeah, it has to be your first, well, any of your first, while you're in your first 4 years. So this slide is technically incorrect. And false is the correct answer. But if it takes you 6 years to finish your first 4-year degree, because you're part-time some of those years, then you can take it for any of those 6 years. It doesn't have to be the first 4. Okay, Daniel, number 3.
False, it's non-refundable.
American Opportunity Credit is, if certain conditions are met, then up to 40% is refundable. Okay, Mercedes, number 4.
The lifetime learning credit is up to $2,000 per eligible student. That is false. It's per tax return.
That's correct. Okay, number 5, which form is generally required to claim an education credit? That's the 1098-T. That's what the college will send you or your student dependent in order to claim tuition and fees for this education credit. And this, forget that note. Okay, the rest of these we can work on together. So there are certain restrictions and requirements for the lifetime learning credit. There are certain restrictions and requirements for the American Opportunity Credit, and there are certain restrictions and requirements for both. So our first one is you must not have any drug-related felony conviction.
That one's kind of written differently.
There must be no felony, yeah, it should be, this or is a typo. It should be no felony drug conviction.
American Opportunity Credit.
That's correct. LLC does not have that requirement. So if you're a drug dealer, you can still get the lifetime learning credit. Qualified expenses can be paid with gifts, inheritances, or the proceeds of a loan.
I said both.
That's correct. Credit is available only for the first 4 years of post-secondary education.
American Opportunity Credit.
That's right. Student must be pursuing a degree or other recognized credential.
False.
That is actually only the American Opportunity Credit. So remember, you can take, you only have to take 1 class to get the LLC, as long as it's not like a purely recreational or hobby thing. It has to have some tangible benefit to your employability. Credit amount is up to $2,000 per return.
LLC.
Correct. Qualified education expenses can be expenses for an academic period that begins in the first 3 months of the year after the year you paid the expenses.
I have the American Opportunity, American Opportunity Credit, but isn't it both of them?
I'm pretty sure that's both. So if you pay your spring semester tuition by December 31st, you can count your expenses this year.
Would you effectively be able to, at that point, count it in either one if you need to? Have that flexibility?
Yes, I believe so. Okay. You cannot claim a credit if your claim is dependent on someone else's return. That is both. The weird rule about the American Opportunity Credit is that you can claim this credit even if you could be claimed but are not actually claimed as a dependent on another's return. And that is the only place in the entire tax code where it asks, does someone claim you as a dependent? Everywhere else, if you could be claimed as a dependent, you might as well be claimed. Okay, great. Let's take a short break and then we'll move on to chapter 11.